Okay, so you want to own a mafia. Recruit some guys, control some territory, collect your cut, watch the money roll in every time someone in your city needs something the government won't provide. Here's the strange part. Most people think organized crime is a cash machine. Easy money protected by violence, basically printing profits forever. The reality is closer to running a mid-sized regional logistics company with catastrophic liability exposure, a workforce you can never fire through HR, and a product line that can become federally illegal to sell without warning. By the end of this, you'll understand exactly where the money comes from, why organizations that survive for generations look nothing like the ones that collapse inside a decade, and why the economics of organized crime turn out to be far more fragile and far more rational than anything you've seen in a movie. Start with the structure, because the structure is the business. A functioning criminal organization isn't a gang, it's a franchise model with enforcement built in. At the top, a small leadership tier sets territorial rules, resolves disputes between factions, and collects a percentage of everything flowing below. Below that, earners, independent operators who pay a fixed tribute upward for protection, legal support, and access to the network's reputation. Below that, street-level workers who take on the most risk for the smallest share of the margin. That three-layer structure exists because it solves the hardest problem in criminal enterprise. How do you scale revenue without scaling your own legal exposure at the same rate? The answer is insulation. The further up the hierarchy you sit, the more removed you are from any individual transaction. A boss who hasn't touched a drug shipment in 20 years is extraordinarily difficult to prosecute for drug trafficking. Prosecutors know this, which is why RICO statutes were designed in 1970 to pierce that insulation, treating the entire organization as the criminal entity rather than requiring proof any one person committed any one specific crime. Before RICO, the franchise model was nearly bulletproof legally. After, running a visible, documented hierarchy became a direct financial liability, because the documentation prosecutors needed to prove the enterprise's existence was the same documentation the enterprise needed to function. Now, the question that actually matters: where does the revenue come from? Most people say drugs, and they're not wrong, but they're describing one revenue line inside what is usually a diversified portfolio. The most profitable criminal organizations historically have not been the ones most dependent on narcotics. They've been the ones that built recurring revenue streams across multiple markets simultaneously, the same way any sophisticated holding company would. Take the numbers seriously for a moment. A mid-sized American organized crime family in its peak operational years, say the late 1970s through the late 1980s, was generating estimated gross revenues somewhere between $50 million and $500 million annually, depending on territory and market control. The gap between the bottom and top of that range tells you almost everything about what drives profitability. The organizations on the high end weren't running more drugs, they were running more legitimate business integration, more labor racketeering, more construction and waste hauling, more financial services for people who couldn't use banks. The diversification wasn't coincidental, it was structural. Here's the part nobody puts in headlines. The most stable revenue stream in organized crime history wasn't narcotics, it was labor. Specifically, controlling unions in industries where labor was the primary input cost. Construction, garbage collection, garment manufacturing, waterfront loading. Industries where whoever controlled the union effectively set the price of doing business in an entire region. A construction company in New York in 1980 that wanted to build anything significant paid a tribute baked into every bid, not optional or violence adjacent. Simply the cost of operating in a market where the alternative was a labor stoppage costing more per day than the tribute cost per year. The Gambino and Genovese families at their height weren't making most of their money selling cocaine. They were making it from concrete. Labor racketeering had a margin profile that looked nothing like street-level crime. Low overhead, modest enforcement requirements compared to territorial drug operations, revenue that was recurring and predictable quarter after quarter. It was, in the language of private equity, a business with strong free cash flow and high barriers to entry, the barrier being the 30 years it took to build the union relationships in the first place. Now the part that explains why so many organizations destroyed themselves from the inside out. Criminal enterprises face a version of the principal-agent problem that legitimate businesses also deal with, but with none of the institutional tools to solve it. In a normal company, if a regional manager starts skimming, you fire them, sue them, refer the matter to law enforcement. In a criminal organization, every act of internal discipline is itself a crime, and every meeting to resolve a dispute is a conspiracy. The cost of maintaining organizational integrity is, paradoxically, more criminal activity. This is why the most economically successful criminal organizations tended to develop something that functioned like arbitration, a dispute resolution mechanism that let members bring grievances to a neutral authority before they escalated into violence. The American Mafia's Commission, established in 1931 after the Castellamarese War, was explicitly this: a board of major family bosses meeting periodically to adjudicate territorial disputes and approve major decisions. It was governance infrastructure, and the fact that it was also a criminal conspiracy under RICO didn't make it less functional as a management tool. It made it more necessary, because without it, the default resolution mechanism for every business dispute was bloodshed, and bloodshed is expensive in ways that extend well beyond the immediate body count. Consider the economics of violence. A murder in organized crime doesn't just cost the resources of carrying it out. It costs the investigation that follows, the witnesses who get nervous, the associates who start cooperating with prosecutors, the media attention that draws regulatory scrutiny to every legitimate business the organization touches. The five families of New York, estimated by federal prosecutors to have ordered hundreds of murders between 1960 and 1990, spent an enormous share of their legal and operational budget managing the downstream consequences of violence used to solve what were essentially contractual disputes. The organizations that survived longest used violence most sparingly, not because their leadership was more ethical, but because the cost-benefit analysis of murder in a high-surveillance environment is genuinely terrible. Here's the part that surprises people. The actual cost structure of running a criminal organization looks like running a high-risk service business with serious HR problems. Your largest operational cost isn't product, it's people. Paying associates enough to keep them loyal, paying lawyers to keep them out of prison, funding the families of incarcerated members to prevent them from becoming cooperating witnesses. The Cosa Nostra had an explicit, if not always honored, expectation that the organization would support the family of any imprisoned member who was earning for the enterprise. That's functionally a pension liability, unfunded and with no actuarial table behind it. And organizations that stopped paying it tended to find their imprisoned members on the phone with the FBI within 18 months. Legal fees deserve their own line item. A major RICO prosecution in the 1980s or 1990s could cost a family several $millions in defense costs per defendant, multiplied across 15 or 20 simultaneous defendants in a single case. The government's strategy in landmark prosecutions, like the Commission case of 1985, which convicted the heads of all five New York families, was partly financial attrition. Spend down the organization's liquid reserves defending itself, while cutting off the revenue streams funding those defenses. By sentencing, several of the convicted bosses had organizations that were functionally insolvent at the operating level. The Commission case is worth pausing on because it illustrates something counterintuitive about the relationship between visibility and vulnerability. The New York families at their peak in the early 1980s were arguably the most powerful and profitable they had ever been. They controlled the concrete industry through the Concrete Club, which required any construction project over $2 million to use a cartel-approved contractor who paid a 2% tribute, generating tens of millions annually from a single industry in Manhattan alone. That level of market control required coordination that was legible. FBI bugs placed inside Jaguar sedans and social clubs captured exactly the documentation prosecutors needed. The more successful the enterprise, the more it had to communicate to function, and the more evidence it generated. Now, the question of drugs specifically, because the economics here are misunderstood in both directions. Narcotics generate enormous gross revenue. The margin at the wholesale level for heroin moving from import to street distribution was estimated in the 1980s at somewhere between 100 and 1,000%, depending on where in the chain you sat. Those numbers are real. What they don't capture is the risk-adjusted return. A kilo of heroin carries federal mandatory minimum sentences measured in decades, and every link in the chain that gets arrested is a potential cooperating witness pointing upward. The asset forfeiture exposure means success itself creates legal vulnerability. The more visibly you profit, the more the government can seize. The rational response, which many organizations arrived at, was to participate in narcotics markets at the wholesale level and insist on strict separation between the organization's name and the retail trade. The Lucchese family's position for much of the 1970s was officially against drug dealing by members, not because leadership had moral objections to heroin, but because the prosecution profile of retail narcotics was catastrophically worse than that of loan sharking or gambling, an actuarial decision that didn't always hold once the money got too large and the individual incentives too strong. Loan sharking has a margin structure worth specific attention because it's one of the most profitable financial products ever devised, operating in a market conventional finance cannot serve. Its customers can't qualify for bank loans or need money faster than any institutional process allows, often gamblers covering a debt immediately to avoid consequences from a different creditor. The VIG, short for vigorish, typically ran between 1 and 5% per week, compounding, with the principal never required to decline if only interest payments were being made. At 2% weekly, a $1,000 loan generates over $100,000 in interest over a year if the principal remains constant. The borrower's inability to repay isn't a default event, it's a revenue continuation mechanism. The enforcement cost of loan sharking is also structurally lower than most criminal markets. There's no product to transport, no supply chain to protect, no inventory to seize. The asset is the debt ledger. The enforcement mechanism is reputation, the credible threat that non-payment has physical consequences. Actual violence against debtors was rare precisely because the threat was so credible. It gets you nothing except the cost of the violence. The rational play is restructuring the debt on terms the debtor can meet while extracting value over a longer horizon. Essentially a subprime lending business with very aggressive collections. Gambling ran on a similar model. The house edge in a numbers operation or an illegal sportsbook isn't dramatically different from illegal casinos, but the overhead is radically different. No building, no gaming commission, no compliance cost, no labor board. The margin a legal casino has to share with regulators, shareholders, and the state, an illegal book keeps almost entirely. The risk is arrest exposure, manageable at low visibility, and a catastrophic losing streak on a major event with too much action on one side. Professional bookmakers manage this the way a market maker manages inventory risk, laying off excess exposure through other books, so no single operator absorbs the full variance of any outcome. Here's the structural reality that explains why these organizations existed where and when they did. Criminal enterprise is most profitable in markets where it can provide a service legitimate institutions cannot or will not provide, where the enforcement environment is weak enough that the risk premium doesn't overwhelm the margin. Prohibition created an enormous market for illegal alcohol almost overnight. The organizations that scaled fastest to serve it built the infrastructure, relationships, and capital they then redeployed into gambling, lending, and labor once prohibition ended. They weren't fundamentally alcohol businesses. They were distribution and enforcement businesses that happened to be selling alcohol in 1928 and different things in 1938. The decline in the economics of traditional American organized crime from the mid-1980s onward came from multiple directions compressing at once. Federal prosecution strategy improved with RICO. Wiretapping extended surveillance into previously protected spaces. The drug economy created enormous new wealth for organizations, primarily Latin American cartels, unbound by the norms that made traditional families legible and prosecutable, but also more dangerous as partners and competitors. Gambling legalization in Atlantic City and beyond eroded one of the most stable revenue streams, and the labor markets that had provided the most durable income, construction, waterfront, garment, restructured in ways that made union control less valuable to hold. The organizations that adapted most successfully moved into legitimate business ownership, not as money laundering vehicles but as actual operating businesses where the criminal network's advantages, cheap capital, enforcement of contracts outside legal channels, preferential relationships with suppliers and customers, translated into genuine competitive edges. A construction company owned by an organized crime family in New York in 1975 had labor peace competitors couldn't buy at any price, relationships with municipal inspectors that compressed timelines, and financing terms no bank could match. That combination made it a legitimately competitive business, not just a front. The line between the criminal enterprise and the legitimate business, in many of these cases, was not a line at all. The economics of organized crime, reduced to their fundamentals, follow the same logic as any business operating in an underserved market with high barriers to entry: violence, reputation, and institutional relationships built across decades. The underserved market is every transaction legal institutions won't facilitate: loans to people with no credit, dispute resolution for parties who can't go to court, protection for businesses where police response is too slow or too expensive to be useful. The organizations that lasted longest managed the liability most carefully, diversified revenue most aggressively, and spent the most on the institutional infrastructure that kept the enterprise running through prosecutorial pressure and leadership transitions. The ones that collapsed earliest chased the highest margin revenue without adequately pricing the risk on the other side of it. Nobody builds a new mafia from scratch either, not in a mature market. The capital costs are too high, the permitting is impossible, and the incumbents have 50 years of infrastructure a new entrant simply cannot replicate. What you see instead is expansion at the margins, acquisition of existing territory and revenue streams, occasional consolidation when an operation no longer justifies the overhead of running it independently. The organizations that exist today in these markets are mostly doing exactly that, running on infrastructure built by people now either dead or in federal prison, collecting returns made in a different regulatory environment, hoping the capacity they're sitting on doesn't get legislated out of existence before they've extracted sufficient return.